Today we are going to be talking about the U.S. exit tax, and I've got a little housekeeping that I need to go over with everybody. So just to note, our webinar will be recorded and a link will be sent to you hopefully by tomorrow, so you get a copy of the slide deck and any other handouts. I'm going to try to answer any Q&A that people may have. If I don't get to it today, I'll try to answer it and send that along with the PDF. Please post your questions in the Q&A box, not the chat box, because that's how we're going to relay all the back and forth if needed. And if you have any specific questions, like about your specific facts and circumstances, I would just be real careful and maybe send those to me in an email. General questions are great, but specific questions with facts and circumstances, I just want to make sure that we're not oversharing certain amounts of information. And then lastly, due to the amount of attendees in the webinar, please keep your mics on mute and your video off, and direct all questions through the Q&A. So without further ado, I am Michigan Santa, as you can see there on the slide. I am the director of the Wolf Group. Today we'll be talking about the U.S. exit tax. The first thing I want to do today, though, is I want to start off with a little bit of context, and I want to talk about the history of the exit tax. The exit tax is kind of near and dear to my heart. I started practicing tax law back in 2006 with the Internal Revenue Service. And, for the first couple years, nothing really new or interesting, came out while I was practicing tax law. And then in 2009, we have the Offshore Voluntary Disclosure Program starts to get hot and heavy. You have the investigation of the Swiss banks by the Department of Justice, and then we have the rules for the exit tax from the HART Act really, kind of came into being, the Notice 2009-85. So it was a lot of new things to kind of consider, a lot of new updates to kind of put into play. And it was one of the first areas of international tax law that I got to really update myself with and learn about and really get ingratiated with. But the exit tax really starts with LBJ, Lyndon B. Johnson. He passed the Foreign Investors Tax Act back in 1966. And that's where you have the original exit tax code, Internal Revenue Code 877, started off. It's roughly about 30 years later that we have our first update to the exit tax, which a lot of you are familiar with HIPAA. HIPAA introduced a lot of different things, but there was a revision to the exit tax, an Internal Revenue Code 877, and they added a two-part test, which is basically known as the liability test and the net worth test. And then later in the American Jobs Creation Act, we see that they revise, again, kind of a third revision or second revision, if you will, to a three-part test, and that version of the exit tax basically exists from June 3rd, 2004 to June 17th, 2008. And then lastly, the HART Act, which comes out in 2008, is the current version of the exit tax that we have. And so one question I do have, because as you'll see here, we have a lot of folks that are expatriating or giving up their green cards, is will this issue be taken up by Congress, the new Congress, or Congress in general, in the near future, in later this year or perhaps in 2021? It's something that's a real big question on my mind. And I think that they probably should update the rules at some point in time. The first part, the first code section, though, that I think you need to be aware of is Internal Revenue Code 6039, capital G, which comes out of HIPAA and basically requires that the Treasury Department publish the names of any U.S. citizen that gives up their U.S. citizenship. And when they do this, they release it every quarter. So every quarter, there's a list of all the names of people that have given up the citizenship. You can go look at all of the names. Some people have told me that they've given up their citizenship and then they go look on the list, they don't see their name. And there's a belief out there that perhaps they only report the quote-unquote covered expatriates versus the non-covered expatriates. So that might be one of the reasons why, if you do give up your citizenship, you don't see your name on the list. But 6039G also kind of incorporated the Form 8854 and the $10,000 failure to file penalty. Basically, the way they get your name for the list is from the 8854. And so that's one of the main mechanisms they use to publish that list. Now, the 8854 has multiple purposes, but that is one of the purposes of the 8854. and one of the driving factors behind the $10,000 penalty. One myth, or one thing that I always hear from folks, is that if I file the Form 8854 late, am I considered to be a covered expatriate? And we'll get into the definition of covered expatriate. I see some people are asking, what does that mean? The answer is no. If you file a late Form 8854, it does not make you a covered expatriate just by filing it late. And as we'll see later on in the presentation, there is a relief procedure for folks that may have not filed the 8854 correctly. You can actually file it standalone if you need to go back and do it and get it into the IRS. So here are the numbers of folks that have expatriated. And what I did is I kind of aggregated the list starting in 2016. And so in 2016, the total number is about 5,400. In 2017, 5,100. 2018, it really dips down low, 3,974. 2019, 2,071. And then over the first 2 quarters of 2020, it's totaled about 5,300 people. And if you annualize that, you're looking at over about 10,000 citizens that will give up their citizenship in calendar year 2020, which is double, pretty much double any previous year, and a large jump by all purposes since they've started tracking the number of people that have expatriated. I will note that the numbers that you're seeing don't include the people that have given up the green card, and they don't include people that have done what's called a treaty tiebreaker on their tax return. And again, we'll get into more about what that means. There was a request several years ago, a FOIA request, FOIA being the Freedom of Information Act, about the green card holders, because people are curious how many people actually give up their green cards. And based on the data that was received, we now know that it's roughly about 18,000 people give up their green cards every year. Estimates have double to triple that number for 2020. So it's going to be, in addition to the U.S. citizens, you could be looking at, 40 to 50,000 people in total giving up either their green card or their citizenship in 2020, which again is a super large number. There's also data floating around from the FBI, because apparently the FBI keeps much better records than the Department of Treasury in regards to the number of citizens that have given up their citizenship. And according to the FBI, their numbers of folks that have given up their citizenship are much higher than the Treasury Department, and in some cases by thousands. So the numbers on the previous slide here could be a little low compared to what reality is. That brings us to kind of where we're at today with the exit tax, which is the HART Act. The HART Act of 2008 basically gives us Internal Revenue Code 877 Cap A and Internal Revenue Code 2801. And those are the two overarching big picture internal revenue codes that now govern everything with the exit tax. It also updates and amends certain other provisions of the tax code. And then the big explanatory notice that we have will be the Notice 2009-85, which I will reference several times throughout the presentation. But the one oddball thing about the exit tax is that there are no regulations. So most of the time you have an Internal Revenue Code, and then you have proposed regulations, you have people giving comments to the IRS on the proposed regulations, and then eventually the IRS will finalize the regulations and will publish the final regulations. And they've done this recently with a lot of the new laws introduced under the Tax Cuts and Jobs Act of 2017. However, for the exit tax, that has not been done. So we still, to this day, here on September 17th, 2020, we do not have regulations for the exit tax. That's one of the reasons why I think perhaps there might be some movement, whether it be by the IRS on putting out regulations, or perhaps by Congress on updating the rules based on the number of people that are going to give up the citizenship and the green cards. Perhaps they'll go back and they'll give us some more insight as to what they're thinking, especially as now that we have tie-ins that are unknown for the Tax Cuts and Jobs Act. Or I won't say unknown, but there's not really much specific guidance on there. You can kind of extrapolate from what they have given us to what's new under the Tax Cuts and Jobs Act, but there's nothing in specific that says treat guilty like this, or treat the transition tax like that, or treat one of the many other various things that are new under the Tax Cuts and Jobs Act for the exit tax itself. Okay, definitions. So first off, the first definition that everyone has to know is, what is an expatriate? Okay, an expatriate is any citizen who relinquishes their citizenship, or long-term resident who ceases to be a lawful permanent resident of the United States. So the first one's pretty self-explanatory. You're a U.S. citizen, you give up your citizenship, you're now an expatriate, okay? The second one, long-term resident, is a little bit more of a, you have to get into the weeds to kind of figure that one out. So if you look at the Internal Revenue Code, it basically says that a long-term lawful permanent resident or long-term green card holder is going to be someone that's held the green card, and the key or magical words here are going to be in at least 8 out of the last 15 years, okay? And in at least means any time under the Treasury regulations. So that means that sometimes we have to do funny IRS math to calculate if someone is a long-term lawful green card holder. And so, for example, here's an example of what I mean by that. So let's just assume that I get my green card on December 31st, 2014. So I'm getting off the plane, I've got my green card, I step foot onto U.S. soil, and it's December 31st. That counts as that one day will count as 1 year, okay? Now I'll go through 2015 all the way through 2019. I'm now in year 7. The moment that I go into January 1st, 2021, that is year 8, and now I'm a long-term green card holder, and therefore I'd be subject to the exit tax. So what I always do with a lot of folks, or what I like to do with a lot of folks, is I like to get to them before they get their green card and do pre-immigration tax planning. And we'll talk a little bit more about that here in a minute. But by doing that, I set the residency start date, and I put in a little section about the exit tax to explain it to them, and I tell them, on this date in this year, you will be considered a long-term green card holder subject to the exit tax, and therefore I would suggest that you plan or at least consider an exit prior to that date, and then I kind of give them my idea of when if they want to do exit tax planning so that they don't have to worry about the exit tax. This is when I think that they should start. So those are some things to consider when it comes to calculating what a long-term resident is. We're going to take our first polling question right now just to make sure everyone's paying attention. So I think that should come up here in a minute. No, looks like, okay, I'm going to move on because we're going to run out of time here. Hopefully we can get the polling questions going here pretty soon. Okay, renunciation and abandonment steps. So this is more of just kind of a laundry list of things to consider. It's in no means immigration advice. I'm not an immigration attorney. I don't practice immigration law, but part of what I do when I do exit tax planning is I always like to do a little bit of a reality check with my client. Because it's a very real life choice that they're making. It's an irrevocable choice. And I've been through this process with a lot of people before. I've had people call me as they're literally outside of the U.S. consulate about to go in for their interview, and they're super nervous. So I try as much as possible to give people the reality of what I've been told. Obviously, I'm still a U.S. citizen. I've never given up my citizenship. I don't really know what it's like, but I like to relay as much as I can about what other people have told me. I've helped a lot of people do this. So, these are some things to consider. On the left-hand side, obviously, are some things to consider if you're going to give up the U.S. citizenship. On the right-hand side, the green card holder is a little bit more straightforward. You just make sure that you mail in your I-407 to the Vermont address, and you'll be good to go. The last point there is pretty critical because I've seen this multiple times. And if you look on the internet, you'll read horror stories about this. But there's no such thing as informal abandonment of the green card. So the common question is, or the common fact pattern I see is, I let my green card expire, I'm done with the U.S., I don't need to file taxes. That is completely incorrect. You may no longer have an immigration status with the United States, and you may not even have your green card. It expired, maybe you threw it away. But you have not, your tax filing requirements have not stopped. They keep going until you formally abandon your green card or some kind of judicial process occurs. So I've had some people that have had an expired green card for 10, 15 years and didn't realize that they were still on the hook to file tax returns until they formally abandoned that green card. So just make sure that if you are going to give up your green card and the purpose is to perhaps stop the timeline or get it to a good point where if you're subject to the exit tax, maybe it's not that bad, make sure you do it formally and you do the process in the correct way. Okay. A lot of other questions I get are more technical, as far as, well, what am I going to put as my date of expatriation? And I've heard this from a lot of people recently, because they've said, I went in, I expatriated, and I still haven't gotten my loss of nationality certificate from the consulate yet. I don't really know what my date of expatriation is, or I sent in my I-407 and I haven't had a response. It's been months. It's, COVID-19's basically shut USIS down. And so basically what I put on here are the items in red are, those are going to be things that are rarely happen to people. Those are like judicial things that happen to people, and it's very oddball and very rare for those things to happen. What mostly happens, though, is you go to the consulate and you renounce your citizenship, and then eventually the loss of nationality certificate will come to you. On the date that you went there, that could be your date of renunciation, or it could be the date you got your certificate. Just depends on which one you want to use. And some people will use the previous one, some people will use the latter one. If you look at the way the rule is written, it's an or test, so you can use one of each, okay? The same thing with the I-407. It's the date that you file it, right? It's not the date that it comes back to you and it's stamped, it's the date that you put it in the mail. And some people are a little worried about that. So in lieu of that, sometimes what we do, and I'll talk a little bit more about this, is we'll do a treaty tiebreaker just to make sure, just to kind of hammer the point home, right? Like, we really want this person to be out of the U.S. tax net, so we'll file a treaty tiebreaker to break them out of the U.S. tax residency. That can only be done with green card holders, though, and it's a very rare thing to do, but I have done it before and have done it successfully before. Okay. And speaking of treaty tiebreaker, here it goes. So the way the treaty tiebreaker works is that you claim to be a resident of another country. You have your green card, but you say, look, I'm going to say that under the tax treaty between the U.S. and some other country, so there has to be a treaty. Because I had a client come to me about a month ago saying, well, we'll treaty tiebreak out of Brazil. And I said, Brazil doesn't have a treaty with the U.S. There's only one country that has a treaty with the U.S. out of South America, and it's Chile, and it's not, to my knowledge, it's still not enforced yet. It's still kind of pending. So you have to have a treaty with the U.S. And if you have the treaty, then you claim to be a resident of that country, and that's how you treaty tiebreak, okay? And you have to file that on IRS Form 8833, critically important, okay? If you treaty tiebreak, then what happens is that if you're a long-term resident, it's going to set you up for the exit tax, or at least you're going to be pulled into the net of seeing if you're subject to the exit tax. If you're not a long-term resident, then it will put a toll on the accrual of the years that count against the 8 out of 15-year test. And so, for example, I've got a client that lives offshore. He's always lived offshore. He won the green card lottery. Kids go to school in the U.S., and he basically does treaty tiebreaker, every single year, because he doesn't want the 8-year test to count. So he hasn't had a single year count yet. And I told him, I said, look, if you ever try to use the green card or you ever come into the U.S., there's a strong possibility that they'll confiscate your green card, assuming, IRS and Customs have their act together. Because that's the danger zone of doing the treaty tiebreaker, is basically you're telling the United States that, you don't want the green card. So it can be done. It can toll the years, and it is definitely something that can be used if you need to do it. Okay. I've had the question asked to me several times, what if I just go back in time and treaty tiebreak, 5 previous years or 2 previous years, then I won't hit the 8-year test. And unfortunately, you cannot go backward in time. You can't do an amended return or a delinquent return with the Form 8833 treaty tiebreaker. That's a big no-no. You will get audited if you do that. And then on top of that, I've seen people do that, get audited, and then they'll get the $1,000 penalty. There's a $1,000 penalty for filing the form late. Which is not bad comparatively to the $10,000 penalties that they have, but that is something to be aware of. And if you look at the Form 8833, you'll see here that it specifically tells you, and then the top of the section, it says, hey, if you file this form and you take the treaty tiebreaker position, you will be deemed to have expatriated pursuant to Internal Revenue Code 877 Cap A. Okay. Now, I have a question here. It talks about a G4 visa holder, which is a non-resident for U.S. purposes, and they're asking if there's anything in particular that needs to be considered for the G4 visa holder. And I guess my answer to that would be go back to my previous comment. If you're a G4 visa holder and you're thinking about getting the green card at any point in the future, I think it's imperative that you understand about the exit tax, because, again, the moment you get the green card, the clock starts to run. And a lot of G4 visa holders, as you'll see as we get further into the presentation here, the pensions, they're going to kill you for purposes of the net worth test. And if you are subject to the exit tax, you know, the inclusion of income is very, very high. In fact, you know, most of the World Bank and IMF employees, you know, they have to be very, very careful about holding the green cards for way too long and then trying to exit the system because, you know, 10 times out of 10, the pension alone will take you over those certain thresholds. So, you know, there are, I think, certain things on here for G4s to be aware of. Okay, earlier there were some folks that were asking about what's a covered expatriate versus, you know, something else. Well, basically the way it works is that, you know, you're an expatriate, right? You're a U.S. citizen that's given up the citizenship, or you're a green card holder that's given up the green card, long-term green card holder. And then from that point in time, you're an expatriate. From there, you're either one of two things. You're a covered expatriate or you're a non-covered expatriate. And the key here is that you want to be a non-covered expatriate. That's the goal. That's the sweet spot. That's where you're not, basically what happens is that you don't have to worry about the exit tax calculation. You just have to certify that you don't pass one of the 3 tests, so you're a non-covered expatriate. You file your final paperwork with the IRS. You may have some residual things if you have U.S. source income or assets, but for the most part, the non-covered expatriate is where everyone wants to be at. And a lot of times we'll do exit tax planning with the goal of taking a covered expatriate and finding a way to make them a non-covered expatriate if we can. In other cases, some folks know they're going to be covered expatriates. Then the goal there is, how do I minimize my exit tax? What things can I do now to make the exit tax less? You know, how do I increase my basis in certain assets? How do I decrease the fair market value of certain assets? So we'll get into that here in a little bit. But the one thing to note is that whether you're a covered or non-covered expatriate, you're going to need to file, more likely than not, a dual status tax return, unless, of course, you're doing a treaty tiebreaker exception. And the dual status tax return is going to be the 1040NR. That's going to be the primary return. And then the 1040 is going to be the statement. And basically, the 1040NR is going to cover the period after you expatriate, and the 1040 is going to cover the period prior to expatriation. And then you'll do that in conjunction with the Form 8854. And if you're a non-covered expatriate, then you may have to do a couple additional things. You may have to do the Form W8B, and you may have to take a look at the tax treaty if you have future sources of U.S. income. If you're a covered expatriate, then it's going to be the Form W8CE on certain items of deferred compensation. You may be locked out of using the tax treaty on those U.S. source income or assets for a period of 10 years. The way you check that is the saving clause and in the tax treaty, and a lot of times I kind of review that with my clients when we do exit tax planning. I'll kind of do a detailed memo of all the things that they should be aware of. And I think one of the things that I see a lot of people miss is they'll walk through and they'll say covered, non-covered, and kind of get you to the very end of the exit tax, but they don't really tell you what to do after. You know, what's the paperwork I need to do after? What about the withholding? What about, you know, things that I may liquidate or sell after I give up the you know, the citizenship or the green card? What about U.S. Social Security? So there's a lot of things that kind of come after the fact when you give up the citizenship or the green card. And then Internal Revenue Code 2801 is one of those things. It's pretty big, and we'll walk through that at the very end of the presentation. So here's what it looks like when you're certifying, just so that you know. This is from the first page of the Form 8854. And basically what I've highlighted there is the 3-part test. And again, the thing here is that you don't want to pass any of these, or you don't want to fail, excuse me. You don't want to fail any of these tests. If you do, then you got a problem. So, you know, it's the liability test, the net worth test, and then the 5-year certification test. So the tax liability test, let's go through that one quickly. Basically what we do is we take your net income tax liability for the 5 preceding years. We go to a spreadsheet, we do the average function. If it's over 168,000 US dollars, then you'll vitiate the test and you'll be a covered expatriate. If it's under, then you pass the test and you're just fine. So a lot of people ask me, well, where do I find my net income tax liability? And there's a whole way to do this. There's a whole way to calculate it. I think it's Internal Revenue Code 55 kind of walks you through the different ways that explains that. But if you're looking on, and again, the tax return has changed a couple times, the format, they've played around with it. I don't know if folks remember, but they were trying to do a postcard that didn't work out so well for 2018. So basically, if you look at 2017 and prior years, it's typically going to be line 56 on page 2 of Form 1040. That, of course, I think you have to be real careful with, because it's not always that number. It can be maybe a number that's a little bit different. And so just make sure that you work with someone that knows how to calculate that net income tax liability properly, because certain credits have to be taken out of the calculation before you can come to that number. For 2018, it's going to be line 13 on page 2 of 1040, and for 2014, it's going to be line 14 on page 2 of 1040. So that's where you can find those liability numbers. Common question that's asked to me is, what happens if I'm married? So I'm married, I've got a joint liability. Can I split that number in two? And the answer would be no. You cannot split that number in two. The joint liability, even if only one person is expatriating, it's a joint liability, and that's what you use to do the average liability test. Okay, moving on, the net worth test. So the net worth must exceed $2 million. If the net worth goes over $2 million, you're going to be a covered expatriate. And the way that we determine the net worth is we look on the day before you either gave up the citizenship or the day before the I-407 was filed. The $2 million is not indexed for inflation, so unlike the average liability test, it's not increased every single year. And the rules for the net worth test are typically going to fall under gift tax rules, basically as if you almost kind of gifted everything away on the day before you expatriated. And people always kind of get stuck between the net worth test and the mark-to-market exit tax. People always confuse the two. They think that they're kind of one and the same thing. They're really not. The calculation of net worth is the first step. It's kind of one of the first hurdles that just to see if you actually have to calculate the exit tax. Once you get past the net worth, there's a whole different calculation that you have to do once you're in the exit tax calculation, and that's a whole different set of rules that have to be considered. So I think that's one thing that I want to make absolutely clear here, is that the net worth test has a different way of calculating the assets that you have or your personal balance sheet. So basically, and this is a rudimentary example, but liabilities do assist, or they do help out. So if you own a home, it's worth $750, and you've got a $500,000 mortgage, then the net worth of the asset is $250. I had one client came to me and he said, I've got the perfect solution. I've got a couple houses. I'm just going to get a bunch of mortgages. It'll reduce the net worth, and I'll be under the $2 million test. And then I asked him, I said, well, what are you going to do with all the cash? You're going to do all these cash out refis. What are you going to do with all the cash? I'll just put it in a bank account somewhere. Well, the cash is part of the net worth test. So you're really just moving money around. You haven't changed your net worth. So unless you're going to be gifting the cash away to other relatives or other folks, that's not really a good kind of way to go about reducing your net worth. So make sure that when you're looking at liabilities, you're kind of thinking about all the angles, if that's a path that you want to take. Another common question we get, and I'm actually working on a couple cases right now where this is an issue, and it's how do I value jointly owned assets with my spouse? In Maryland, I believe they have the tenancy by entirety. In Louisiana, it's going to be community property. California, community property. So each state has their own different marital property laws, and in some cases, I like to get attorneys involved to maybe do a quick run through of their marital property laws so that we don't miss anything. Especially if it's in a state that I haven't worked with before, I may try to do a quick deep dive into the property laws just to be careful that we're doing the proper analysis correctly and that we're allocating. Some states allow tracing for source of funds to value the assets. It really just depends on kind of what state and what assets that you have. But you basically take a look at the assets and then value for each spouse separately. And you basically look to the marital property laws of the state to make those determinations. Another question we get is, do I need to submit an appraisal? Some people do this. They will submit appraisals with the 8854. They'll get an appraisal on just about everything. It's not necessary. You don't need to do an appraisal. The IRS doesn't, you don't have to do an appraisal on a home. The IRS doesn't require it, but they require good faith estimates. That's what the notice says. But in some cases, especially if I'm super close to the $2 million threshold, I will say maybe it's a good idea that we get an appraisal, not necessarily to send into the IRS, but just to have on file. If the IRS ever comes back to audit the issue or has a question about it, I think it's good to have a solid audit file and make sure that we can, prove whatever numbers we're trying to use. Okay, how do I value deferred compensation? So when I say deferred compensation, I'm typically going to be talking about an IRA, 401k, some kind of retirement plan. And for the most part, most retirement plans are going to be what we call defined contribution plans. So your employer puts in a certain amount, you put in a certain amount, you can look at the value. I know a lot of people under COVID-19 were worried about, is my value of my retirement plan going to drop? Is it going to, what's going to happen there? But basically, you just look at the value of your plan, and that's the value that you would use for the net worth test, whatever is in there. So the employer contributions, employee contributions, and the earnings and accretions, and whatever that value was the day before you expatriated, that's typically the value that you're going to use for the net worth test. Defined benefit plans, which are a thing of the past, those things have really gotten our society in general into a lot of trouble. A lot of defined benefit plans are very difficult to fund over a long, people are living longer than what was intended under a lot of these defined benefit plans. So you have a lot of plan administrators that are, seeing some trouble with maybe funding some of these plans for the long term. So they're a thing of the past in a lot of jurisdictions, not just the United States. But for defined benefit plans, sometimes, I think that with those, I like to get an actuarial valuation. And I typically like to work with an actuarial that has experience with looking at retirement plans, especially if I have a client that has foreign plans, foreign retirement plans, or foreign pensions. You'll need the actuarial not just for the net worth test, but if they do hit the exit tax, then there are other considerations where an actuarial can save you a lot of money. Social Security. So I get this question a lot. Well, do I need to get my Social Security statement? Do I need to figure out what I'm potentially going to get? The answer is no. U.S. Social Security is not an asset for the exit tax. If you have foreign Social Security, or what you believe to be the equivalent of foreign Social Security, you don't need to get that number either. Those are not items that you need to list on the net worth test for the exit tax. Another common thing that people ask me is, well, if I exit, I won't get my Social Security. That is completely wrong. You will, if you qualify for U.S. Social Security, even as an expatriate, you will still get U.S. assuming it's around. You will still get your Social Security payments. So, and I have a lot of people. I've got a client in Australia actually that she expatriated several years ago. She just started drawing on U.S. Social Security. They send her the checks, she deposits them, and we report it. So it's a common thing. Here's an example of everything they're going to ask you to put on the balance sheet, if you will, your personal balance sheet for the net worth test. And again, a lot of people will look at this and they think, oh, this is how the exit tax is calculated, and it's not. This is just for the net worth test. This is just your balance sheet. This comes straight from the Form 8854. And the comment that I will make here for those people that are maybe practitioners or maybe a little bit more savvy about U.S. tax filings or have some kind of complexity to their filings would be the lines 5A and 5B. That's brand new for 2019. And I think, my guess here is that there is some tracking that they're now doing here for CFC reporting, controlled foreign corporation reporting. And I think a lot of people were perhaps thinking that, look, the transition tax really wipes out a lot of my E&P or earnings and profits of my controlled foreign corporation. So now that reduces my in turn reduces my net worth because I had to pay that transition tax. I'm now at a point where I can expatriate and get out without being a covered expatriate. I've seen a lot of folks do that. And so I think they're wanting to make sure to do those tie-ins because the transition tax is severely underpaid. The transition tax, which comes from the Tax Cuts and Jobs Act of 2017, is basically one of the key motivators or key things that was supposed to cover the reduction in rates and all the good things that came out of that bill. And the revenue raised has not really come anywhere close to what they thought it would raise. I think when they originally pitched the idea, it was like $5 trillion, and they haven't got anywhere even close to that under the transition tax. So that's why I think that is there. The 5-year compliance test basically says, let's take a look at your previous 5 years. Is everything hunky-dory? Did you file everything correctly? I basically put on my auditor hat and I go through tax returns with a fine-tooth comb. And I'll point out all issues, errors, mistakes, whether they be big or small. $5 of unreported interest income, you check the box here incorrectly. This didn't tie up or loop in. Your foreign tax credit carry forward is overstated, whatever it is. And then from there, you can make a materiality judgment. Do I need to go back and make some changes? Do I need to make some amendments? Do I need to, perhaps do some kind of IRS amnesty? Maybe I forgot several foreign financial assets that I need to report. And I will tell you that I think the compliance test is one of the overlooked tests that a lot of people just don't really give much credence to. They're like, hey, I've been using the CPA, or I'm certain my tax returns have been done correctly. And I always tell people, well, go read about the Topsnick case. Basically, the way Topsnick was hit with the exit tax is that he didn't file any tax returns. Now, there's a whole host of issues in the Topsnick case, but one of the big ones that they harped on was the compliance test, and basically said, like, look, whatever he did file was incorrect, and he hadn't filed certain other ones. So I think it's always good to call in and check with the IRS. Are all my tax returns on file? We had one client out of India the other day where the 2017 tax return wasn't showing. The IRS had it, but was flagged for identity theft, and because the client was in India, the IRS was never able to connect with the person to verify identity. And so basically, we're only seeing 4 out of the last 5 years as being processed, and that's an issue, right? You fail the compliance test, you're covered expatriate. So we go in, we resolve that issue, we make sure the IRS processes the return, and you're good to go under the compliance test. It can get super nitpicky, and this is just an example of some of the things that I've seen, kind of raises issues under the compliance test by the IRS. I had one time, it was pointed out to me that a client had not filed Form 720 to report the excise tax on foreign life insurance premiums, which is an oddball form. And I've actually mentioned this form to a lot of other practitioners. They always look at me like, wow, how do you know about that form? And I'm like, well, I happened to be in an audit where it was raised, and I didn't know about it prior to that audit. But it's out there, and it's one of those things where you can get blindsided by just little tiny things. And if you think about life insurance premiums, what's 1% of $500,000? It's not much. The tax loss to the IRS was very minimal here, and the client was lucky to get off without anything negative. It was not reclassified as a covered expatriate, but that's how nitpicky it can get if you get picked up for those issues. The other thing is to be very careful with the IRS on certain forms if you haven't filed them. In addition to the exit tax, so there's being a covered expatriate, but there's also perhaps getting into a compliance test review and the IRS kind of digging deeper and saying, hey, you haven't filed Form 8938, to report X, Y, or Z. You haven't done the transition taxes, or Forms 965 and 965A. You haven't done 3520 and 3520A to report certain pensions. So the penalties can really add up very quickly under a compliance test audit. And if you do need to, regularly what we'll do is we'll have folks, submit under one of several compliance methods or programs to come back in compliance, just to make it squeaky clean. That way they can feel comfortable about what they submit to the IRS when they do their exit tax filing. The relief for former citizens, I bring this one up just because it is a compliance, it's an amnesty program that just came out. And it's really geared towards what we call accidental Americans. So basically the way it works is if you are a U.S. citizen and only a U.S. citizen, you can't be a green card holder, and you meet certain criteria, so you've never filed a tax return, you don't even need a social security number, right? You just figured out maybe, you were born in Wisconsin, but you didn't realize that you were born in Wisconsin, right? So you're a U.S. citizen. You figure that out. As long as you meet these criteria, then all the IRS is going to want you to do is to file 5 previous tax returns and then your final dual status tax return. You do the 8854, make sure you do your loss of nationality, give a copy of your passport, and similar to the offshore voluntary disclosure program, you will get a closing letter saying, hey, you're good to go, you're out of the U.S. tax net, nothing more is needed here. And then if you look on the right-hand column, that's the procedure, the FAQ 24. If perhaps you exited the U.S., maybe you filed all the paperwork, you did the dual status return, but you didn't know that you needed to do the 8854. And so if you need to submit the 8854, then you can always do the FAQ 24 as a standalone. I always recommend to clients when we're doing the 8854, regardless of whether they're covered or non-covered, let's put a 2848 on file. Let's make that a matter. Let's have our firm monitor all notices and correspondence. If the IRS is going to question this, they're going to have to come to me first, so I get to talk to them, I get to figure it out. That way you're not blindsided by a call or some kind of overwhelming situation, and I can kind of be that thin red line between you and the IRS if any issues do arrive. A couple exceptions to being a covered expatriate, dual citizen by birth. So If you're a citizen of the U.S. and a citizen of another country when you were born, you're a dual citizen by birth. As long as you continue to be a resident of that country, a tax resident, and you haven't been in the U.S. And satisfied the substantial presence test for 10 out of the last 15 years. We've seen a ton of people like this. Most of them are New Zealand and Australia. Then basically you get a pass, right? You could be rich worth $1 billion, and there'd be no exit tax because you basically get an exception to the rule. The other one is that if you give up your citizenship before you turn 18 and a half, then that's another exception to the rule. I've had several parents try to take their young minor children to the U.S. consulate to try to give up the citizenship for the child. The consulate has told them you can't do it. They have to be at least 18 years of age to take the oath of renunciation. So basically, in practical reality, you basically have a 6-month period from when they turn 18 to when they turn 18 and a half to make this work. Some people say you could even do it at the age of 16, but honestly, I think most consulates will tell you that the child has to be, or the person has to be 18 before they can give up the citizenship. So be very careful with that second exception. Last bite at the apple. So this is from what we call an active campaign. The IRS is now basically telling us what they're going to audit. They don't have all the resources to audit people, to cast that wide net. They basically have been defunded since 2011. And so this was released last year, I believe it was November of 2019, and basically saying, like, look, we're going to take a strong, hard look at the Form 8854 that's being filed. And if we do some tie-ins and we see there's some issues, maybe with, the 5-year test, or, we do a background on the client and we notice that their net worth is drastically over $2 million, but they told us it was $1.7 million, we're going to send, soft letters. We may audit the person. We may do some more activity than we've done before. So be aware that there is this international practice unit. The good news, though, is that the governing body, the one that kind of tells the IRS they're doing a good job or bad job, TIGTA recently came out and said that the IRS hasn't really done much with these campaigns. They put them out there, but the actual activity has been very minimal. The bad news is that when TIGTA does that, the IRS normally responds by actually doing something. So it's kind of like being told that you're doing a bad job at your job, and then you kind of like, really going overboard to show your boss that you're doing a good job. Okay, the mark-to-market exit tax. We're going to move on. So we've gone past the 3 tests. I'm going to now assume that you're a covered expatriate. You either have, more than $2 million of net worth, your average liability exceeds the 168, or, the 5 years of compliance are not going to work for you. So now we're into calculating the exit tax. So there's a couple different ways the exit tax, quote unquote, is calculated. The first is going to be the mark-to-market, which is the majority of almost all the assets you own will be calculated under the mark-to-market test. Okay. And so what the mark-to-market test is it says you're going to be deemed to have sold everything you owned on the day before you expatriated. And what they're going to do is they're going to value the fair market value under the estate rules. So it's a little bit different than the net worth test, which is the gift rules. These are mostly going to be the estate rules. Now, there are a couple gifting rules we use. So, for example, if you have life insurance policies or some kind of insurance policy, then I think there's a gift rule that you have to use for that, for the mark-to-market exit tax. But they're very minimal as far as the ones that aren't in the estate rules. So the gain, then you get to apply what's called the annual exclusion, which for 2019 is $725. That will reduce your gain, and then from there, anything over that is going to be taxable to you as a capital gain. Okay. And so just to make sure you guys understand where the IRS is coming from on this language, here's the exact language of Notice 2009-85. It says, you must act as if the person died on the day before they expatriated. That's how you do the mark-to-market regime. And that's a little morbid, and that tells you really what they think about expatriates, but that's how you have to come across. That person has passed away, they have died, that's why we're using the estate rules, and we're acting like everything is going to their beneficiaries, but in a sale format. Okay. So again, just to walk you through the steps, we take all the assets, we divide them into gain assets and loss assets. So this is one thing that I think a lot of people don't realize. Like, you could have a bunch of loss assets and you could have a bunch of assets with built-in gain. It's not all into one big pot. You have to divide them out. And then you use the exclusion only on the gain assets. The loss assets are kind of put into a different column, okay? And that's how you kind of do the calculation for the mark-to-market exit tax. One thing to note is that if you use up your annual the exclusion amount, the 725, and you're under a covered expatriate exit tax calculation, and then you later come back and become a green card holder again, become a citizen again, which has happened, and then you give up all that stuff again, and you're a covered expatriate. At that point in time, you can only use the amount of the exclusion that's left over. So if I've used up $525,000 on this first go around, and then I expatriate a second time, I'll only have a certain portion left over, maybe 225 or whatever the inflated amount is at that point in time, to use on my future exit tax. Here's an example of an exit tax calculation, what it typically looks like. And so again, there's the exclusion ratio, which we calculate in a spreadsheet. We plug the assets in, fair market value basis, the gain loss columns. We apply the exclusion to the different gains, to the different gains. Then there's a residual that comes through. And in this case, asset 1 and asset 2 are going to be reported on Form 8949 of Schedule D. To go quickly, because we're running out of time, when you do an expatriation, if you are an owner of a controlled foreign corporation or you have foreign corporate stock, generally speaking, it is going to trigger a deemed sale of that stock. So there could be a bunch of different things, and this is where I was speaking earlier about the impact of the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act has ushered in a whole new set of rules. So 245 Cap A, the transition tax, the GILTI tax. Understanding how all of that works with the exit tax is going to be critically important in a situation like this. And a lot of times you're going to need to get a business valuation. You need to make sure that you find a good firm that knows kind of what they're doing to be able to value that business properly and give proper discounts. And then a lot of times we've seen a lot of folks do GRAs or gain recognition agreements under Internal Revenue Code 367. There is a coordination with that under the exit tax rules that kind of comes before you get into the exit tax. Foreign grantor trust. So if you're an owner of a foreign grantor trust, basically it's going to be treated as you sold the assets to yourself, from the trust to yourself. That's the way the mark-to-market tax is going to apply. There's also coordination with Internal Revenue Code 684 that you need to be careful with. Most of the assets for the mark-to-market exit tax are going to be on Schedule D in Form 8949. Some are going to flow through on a Schedule E and some of these other schedules and forms that I have listed down here, but the majority go on Schedule D in Form 8949. And then in some cases, after you've paid the exit tax, you can actually use that to your benefit. So I had one client that was going back to New Zealand, and I did a little research into the New Zealand treaty, and lo and behold, it had a fantastic provision for the mark-to-market exit tax, and basically said that, look, if you had to pay this in the United States, then it's something that you can use to your, you can use it to your advantage when you get to New Zealand. So it really helped the client, with the amount of exit tax paid in the U.S. They were able to do some adjustments once they got to New Zealand. So don't overlook the treaty on the exit tax. Don't just think that it's not there. Make sure, go in there and look at all the protocol, look at all the technical explanations. Do your Control F, type in, exit tax, see what it says. You never know. You may get lucky and get a good provision for your client or for yourself. Outside of the mark-to-market, there's going to be an alternative tax regime for certain items. So this is going to be deferred compensation, so retirement plans, specified tax-deferred accounts, 529 plans, Coverdell accounts, Archer accounts, things like that. Interest in non-grantor trusts, which is a fantastic planning mechanism, non-grantor trusts for the exit tax. And then PFICs, obviously I just talked about the 367 and 684 coordination codes. And then a lot of people don't realize this, but if you exit the U.S. but you still own U.S. real property, and then later sell the property, there is Internal Revenue Code 879 that you're going to have to contend with. So a lot of times the strategy that I have with folks, and we'll talk about this a little bit later, is to sell the property before you exit, because on the deemed sale will have an effect to a certain amount, but you won't get all the benefits you could have gotten. And then you'll also have to deal with the actual sale at a later point in time as a non-resident, which for any G4s that have ever sold U.S. real property, they can tell you it's a headache. Okay, so deferred compensation. Deferred comp basically breaks down into eligible versus ineligible. Eligible are going to be your U.S. retirement plans, so your 401k, your IRAs, things like that. Ineligible are going to be foreign pensions, offshore pensions, in some cases international organization pensions, Those can also be ineligible because it's not a U.S. payer, so the payer has to be a U.S. person for it to be eligible, or they have to agree to be treated like a U.S. payer, which most of them won't. So 9 times or 10 times out of 10, all foreign pension plans are going to be ineligible, and there's a special way you have to coordinate with an eligible deferred compensation. That's where a lot of work comes in when you're doing exit tax planning. If it's eligible compensation, though, it pretty much has no effect until you start making withdrawals. It basically is removed from the exit tax calculation. And then when you start making withdrawals, they basically withhold at 30% for each distribution that you get from the eligible deferred compensation. This is an area that I think in actuarial, I love to get actuarials involved in. So if I've got a green card holder and they were performing services, or maybe someone that was a non-US citizen for a while before they became a citizen, or you had a non-residency period and they have a deferred compensation or an eligible deferred compensation plan, you can actually reduce the amount of the income associated with that. If there's a net present exclusion or the taxable amount of the 30% withholding, you can reduce those amounts. But you have to be able to calculate, what is the allocable portion for the period of time before they became a U.S. tax resident. And then if there is an increase in value after they give up the green card, but before they liquidate, you can also kind of remove that out of the equation as well, too. So there's some things to do there and some things to think about, and that can sometimes be an ongoing calculation. So again, getting a good actuarial to do that work is critical. You have to give the form W8CE. So if you're a covered expatriate and you have eligible deferred compensation, you've got to give this form. I think if I go back here, you've got to give it within 30 days of when you expatriate. So if you go to that meeting with the U.S. consulate, you better know that you're a covered expatriate, because the moment you do that expatriation, it's 30 days, unless you're going to take the latter day when you get the loss of nationality certificate back. It's going to be 30 days. You got to give that to all your IRA and 401k providers, because they have to, in turn, within 60 days, tell you what your value is for reporting purposes. And then they also need to be withholding 30% on any distributions. So very critical that you do that. If you don't do that, it could convert what is eligible deferred compensation into ineligible deferred compensation. And the problem with that is that you will then be deemed to take a full distribution, so a net present value distribution, immediately upon exit, instead of doing the 30% withholding tax. So very, very bad result, very critical form, the W8CE. PFICs. So PFICs are basically going to be foreign mutual funds. So when people hold foreign mutual funds and they're U.S. tax residents, it's kind of like holding kryptonite. It's very tax toxic. It's bad. We hate this. We don't like it. I can get on my soapbox and give you a long, drawn out, spiel on this. I've talked to a lot of people about PFICs. There's a proposed regulation which still has never been finalized. So it could hold weight. It could not hold weight. It could become final one day, and if you've gone against it, then you've got a little bit of a problem. But basically, it says that if you hold the PFIC when you expatriate, it's a deemed disposition of the PFIC, and therefore you're likely into some kind of, if you're in 1291, then you're in the 1291 excess distribution method. So you just got to be real careful when you have PFICs. I generally like to put together a plan of PFIC divestment before an individual expatriates, if that's what they're holding. There's an election to defer the exit tax. This was done by a lot of folks when the exit tax first came out. Most people I see these days just pay the tax or find a way to pay the tax if they owe it. It's a whole rigmarole. It's you got to put down a security deposit. I think it's like you have to get an surety bond, and there's all sorts of things that you have to do. You have to enter into an agreement with the IRS that you're going to pay the money, and there's just a lot of moving parts to it. And so it's not something that I've seen done recently. Okay, to wrap up on the code sections that are applicable, the last one here is the 2801 section, which is a heavy hitter, and it basically says that if you're a covered expatriate and you give a gift or an inheritance to a U.S. person. So, for example, I'm a covered expatriate. I'm living in, let's say, the United Kingdom. My son decides to go to college. He's a non-U.S. person. He decides to go to college in California, and I pass away, and then all my assets go to him while he's in California. Let's say he's not on a student visa. Let's just say he satisfied the substantial presence test. Now the inheritance might fall under Internal Revenue Code 2801, and it basically says that my son would have to pay the estate tax at the highest rate, regardless of whatever the amount of the bequest is, which is pretty extreme. It's one of the only inheritance taxes that we have in the United States tax code, and it can be really, really nasty. There are some things you can do, though, to kind of help yourself out with 2801. So a lot of times what I will do is I will counsel, if someone's going to be a covered expatriate, I will counsel them. This is part of the after the fact kind of things, on things to think about with 2801, especially if they have U.S. citizen children, or they have folks that may be thinking about coming into the U.S. later on in life. And the funny thing about the 2801 rules is that there's this Form 708 that's supposed to be published to do the reporting of the tax. It has never been published. So it was promised to be published in 2009. They've never published it. So if you had the situation, which we have had before, there's really no way to report it. And so then you got to get creative. Do you do the you can do the 709 and kind of mark that out and do the tax that way. And then also, as I indicated earlier about the regulations, if you look at the notice 2009-85, which comes out to explain 877 Cap A, it basically says we're going to issue, we the IRS are going to issue regulations, and they never have. So we're still waiting to this day on 877 Cap A regulations. It's been a very long time. Planning tips, these aren't all of them. I'm just going to give a couple small ones that I think are relevant. So if you're before the 8-year period and you're a green card holder, look to abandon your green card voluntarily if you really don't want to mess around with the exit tax, or use a treaty tiebreaker position. If you're after the 8 years, then you're going to need to think about pre-expatriation gifting. And there's a whole wide variety of things that you can do to make that work. You also want to consider there's elections that can be made, a special election for green card holders called the inbound step up in basis rule, where you basically can step up the basis to your residency start date. That's why knowing pre-immigration planning is so important, and knowing the start date. Because if you are ever going to do this election, I got to know the date. And if you don't know the date, then we got a problem. So documenting the residency start date is pretty critical for any non-resident, such as a G4, converting over to a green card. Timing, the longer time available, the better the outcome. And so again, there can be pre-expatriation gifts that you want to do. You definitely don't want to do that in the same year that you expatriate. You may want to churn assets. You want to churn the basis of assets to make sure you have a higher basis so the gain is smaller. You want to lock in, if you can, maybe you have depressed assets. Perhaps there's a COVID-19 crisis somewhere and assets are dropping due to that. That can potentially lower the gain under the exit tax. The sale of assets under Internal Revenue Code 121, use of passive activity losses. Here's the 121, and basically what 121 says is that if I own property and I've lived in it, U.S. real property, or actually property anywhere in the world, and I've lived in it for 2 out of the last 5 years, I can exclude $250,000 of gain as an individual, or $500,000 of gain married. You cannot use this exclusion, though, on the mark-to-market exit tax. So if you have a home that you're living in and you exit and you haven't sold it, you don't get the 121 exclusion. So sometimes what we tell folks to do is, sell the home, get the 121 exclusion so you can use it to your advantage, and then do the exit. Because otherwise, you're not going to be able to use it when you're doing the exit tax. There are a lot of different countries that people are looking at to expatriate to. There's a whole host of firms that help people do this. They help people get passports, which then give them access to the EU, China, Russia, wherever they're trying to really integrate with and go into. So I'm just giving you a list of countries that I've seen a lot of folks go to. I know a lot of people love to go to Singapore and St. Kitts and Nevis. Those are the top 3 that I normally see. Grenada is great for folks looking to come back in the U.S. because you typically can get under the E2 visa. Although some people are scared of, I believe, the Reed Amendment, which says that technically you're not allowed back in the U.S. if you're an expatriate. But I've never seen or heard of anyone be denied that under the Reed Amendment. And then the last couple slides, I basically just kind of give a couple thoughts about, tips and thoughts about things that I've seen and things to consider, just kind of codifying what I've already recently said. For example, some things that I've learned over my time, like if you have an FBAR filing requirement and you expatriate, then you got to do the FBAR for the entire calendar year. Whereas if you're doing the 8938 in conjunction, it's only up until the time that you you expatriate. So that's a little bit of a weird dichotomy that I've seen come out of there. If you have questions, I love questions. I love talking about these issues. I obviously don't have all the answers, but I promise you that I can find you the answer, or I can try to find someone that has the answer. Please send those on over to us. I'm a little bit over on my time, but we did start a little bit late, so I'm going to take a couple questions here. There's a whole slew, and there's about looks like 41 questions here. So I'm going to pick a couple of these and try to go through them as best I can and see if we can knock out a couple of these before we get done here today. So let's see here. How can they enforce a law without regulations in place? So basically the question is asking, you have Internal Revenue Code 877 Cap A, but no regulations. How can that be enforced? Well, that can totally be enforced. The law is what the law is. The regulations just are written by the IRS to help explain how the law should be applied and worked in different factual situations. And believe it or not, there's actually a lot of different sections of the Internal Revenue Code that either don't have regulations or have proposed regulations that have never been finalized, or temporary regulations, or you know, the IRS these days, I feel like they're grasping at weeds. they're doing frequently asked questions which they don't publish, and I tell people all the time, you got to be careful with relying on frequently asked questions because they're not published. You cannot rely on them. You cannot rely on instructions to forms. If you ever go to a tax court or some kind of legal proceeding and you try to say, I read the instructions, I relied on the instructions, I relied on the FAQs, not going to work. That will not be something that will be to your advantage. The residency start date is the first date of green card or the first day in the U.S. I heard this once. So it is my understanding that the residency start date is the day that two things occur. One, you have the green card in your hand, and two, you're on U.S. soil. So for example, if you get the green card and you were in a non-U.S. country, then that is not your residency start date. The residency start date occurs when you get the green card in your hand and when you're on U.S. soil. It's not the date on the card. The date on the card is the immigration start date, not the tax residency start date. Again, the day it's in your hand and the day your feet are on the U.S. soil. G4 visa holders will not be long-term resident even if living in the U.S. greater than 8 years. Correct. That is correct. G4 visa holders are non-residents. A long-term resident has to have a green card. So if you have a green card, then you can be a long-term resident, but you can't be a long-term resident as a G4. If one is previously a green card holder, then becomes a U.S. citizen, does the number of years as green card get counted? I don't think it really matter at that point in time because now you're a citizen. So if you give up your citizenship, you're gonna have to deal with the exit tax rules regardless, even if you only had it for a year or even a day. So I don't think it really matters how long you had the green card before the citizenship. Although perhaps I'm missing something there. Can we keep the green card by renewing it until we die? Or the authority may tell us suddenly that they cannot renew it unless we become a citizen. I don't know if you can keep it in perpetuity. And honestly, with the way that the immigration laws are going in this country, I think that that's something that you'd want to consult with an immigration attorney about. But again, I think if you're over the 8-year period, your head should be thinking about the exit tax, because if you have a judicial proceeding or some kind of revocation judicially from the United States, it could trigger the exit tax. And again, I said that was rare, but it has happened to some people, so be real careful with that. What is the rationale for imposing a tax on people who no longer want the residency or citizenship? Can you explain? It'd be too long for me to explain this on the webinar, but there are some really great articles that go through the whole history of this. It really, again, starts with the FIDA Act back in 1966 under the LBJ administration. And in fact, if you look at the history of tax law in the 60s and 70s, and you want explanations for why we do worldwide taxation and international tax rules and expatriation, a lot of the rationale is either reinforced or comes out of that time period. The FBAR is, a lot of people always say, well, the FBAR, George Bush started the FBAR or Obama started the FBAR. No, the FBAR is Richard Nixon. The Bank Secrecy Act is Richard Nixon. It comes way before. So if you want to learn more about the international tax, you just literally Google it. There's a lot of tax professors, PhDs of tax law, that have opined and written the history of all these things, and you can read more about why the policy is the way it is. But if folks are, I'll tell you that if folks feel like the policy should no longer be applicable, these are things you should talk to your Congress people about, and definitely let's get some change going here. I would be more than happy to not do exit tax engagements and have this whole thing go away, because it is very, very time consuming to do these engagements. I like doing them, but at the same point in time, I'd be more than happy to not do them. Green card holder gifting to his wife to get below the $2 million limit. In certain cases, that could work. I would just need to know more about that situation. If a minor child received their green card before their 18th birthday, does the 8-year exit tax clock start from the day they received their green card as a minor, or does it start on the 18th birthday? The 8-year clock starts when they are a minor. So yeah, that's a little bit of an issue right there. Can you talk about the notion of covered expatriates for children? I remember some negative tax consequences on children. Yes, children can be covered expatriates. I have dealt with this before. It is a very, very nasty situation. And if you look at the rules on children, you know, to break a child out or to do the filing, most of them don't have the net worth to be over the $2 million threshold, but they still have to do the 5-year compliance test. So filing 5 years of tax returns for children can be, I think it's ridiculous, but in some cases you have to do it. If you're a green card holder and give up your permanent residence after 5 years, you have to pay the exit tax. Well, likely the answer to that would be no, because again, it's 8 years. But I think I would love to learn a little bit more about the exact facts before I give it a final answer, if you will. I have a client that left the U.S. when she was 3 in 1946 and has never been back, but only gave up her U.S. passport in 2006. She's a resident in the UK and has a British passport. She's never completed a US tax return. What is her status? Well, her status is she's going to be an expatriate of the US. I can't tell whether she's covered or non-covered. She's going to fall into the old exit tax rules, which is the 877 rules, the third iteration of those. And if she really, really wants to be on point, she's not going to qualify for the relief procedures because that's only for people that gave it up after, I believe, March 18th, 2010. But if she really, really wants to be on point, then she would she'd do the 10-year filing. So basically, she files 10 years of tax returns and the 8854 to go with it. I think she does the 8854 initial and then annual for 10 years. I forget how that works under the 877 rules, but that you could do that. I had a client that actually has gone back and done that because they had their green card pulled or gave it their green card in the old rules, and then are now coming back to get a new green card. So that's an interesting scenario. Does net worth include assets in the country repatriating to? Well, yeah, it's worldwide assets. So when we look at your net worth, it's everything you own worldwide. Does the net worth include the net present value of the World Bank or IMF pension? If so, all or only taxable? Yes, it can. The World Bank pension and the IMF pension can be an includable asset for the net worth test. Remember, though, it's going to be the gift tax rules, so it could be the valuation could be a little bit different than the net present value. Does your net worth get calculated on US assets only or global assets? I just answered that to be global. Does the asset total list include both foreign and US? Yes, I just answered that. It's both. Let's see. Is the UN pension a foreign pension? It depends on which pension you're in, but in some cases it can be. If I have more than $2 million in net worth, do I have to pay the exit tax if I abandon my green card before the 8-year point? The answer would be no. But again, I will qualify that I'd love to see the facts and circumstances to clearly determine that you don't have the 8 years, the 8-year holding period. Is the calculation of the assets, in the calculation of the assets, do you add the present value of any kind of annuity products? And I'm assuming what they're talking about is the calculation of the exit tax, but I think for that particular question, I would need to know more to determine, are you talking about the net worth or the exit tax? That's a long one. I've answered that one already. I plan to get married to a non-US citizen soon, but also plan to leave the US within the next 5 years. Should I still get married? Look, I'm one of the folks that I don't believe that you should let the tax tail wag the dog. I do believe, though, that you should plan. Everyone should have a plan for almost everything they do. You can't stop the rainy day, but you can definitely have a really solid umbrella just in case. So if you are planning on marrying a non-US person, I definitely think you should go for it. Love is love. Love is great. But you should consider exactly what that may do to your tax situation, both in a filing status situation, as married filing separate is the worst status you could be in under the tax code, at least in my opinion. But also, if you guys end up having joint accounts or joint assets or estate planning purposes, there are all sorts of ramifications that come out of that. And the proper plan will go a long way to getting that done. How does the 5-year compliance test apply to minors less than 18? I think I answered that. Unfortunately, it is my opinion that they do have to file the 5 years of tax returns. If I want to give up my green card when I'm 70 and I get an IMF pension of $100,000 a year and have no property, how will the IRS calculate whether or not I fall under the $2 million? If I go above the $2 million threshold, which percentage will apply? That's a very, very specific situation. And again, I think I indicated before that the IMF World Bank employees, that has to be looked at very, very, very closely, especially for long-term green card holders. Most of the time, it is my opinion that the exit tax will be too much of a burden to give up the green card unless you absolutely want out. And at that point in time, then we just try to minimize the exit tax as best we can. Let's see. Can you provide a clear explanation of how to date the point at which a green card holder is subject to the exit tax? Well, typically, again, whatever date that they start, the residency start date is, that's going to be year 1. And then literally you just count the next, 6 years, and so now you have 7 years. And then on January 1st of the following year, once they hit that date, that's the 8-year period, and that's when the green card holder will be subject to the exit tax rules in general. As far as whether they're subject to the exit tax, then you just have to do the 3-part test, which is the net worth test, the 5-year compliance test, and the 5-year liability test. And if they fail one of those 3 tests, then you got to calculate the exit tax, which may or may not be applicable. I mean, it may or may not be impactful, I'll put it like that. Does it make sense to give up a green card if someone has children born in the U.S.? That's a very, very specific question. And again, that has more than just tax implications to it. That is a lot of different moving parts and probably needs a consultation on multiple levels. Are there any possible complications for the tax treaty of U.S. Japan or U.S. Singapore? I'm not sure. I really can't tell you. It's been a long time since I've looked at both of those treaties. I know the U.S. and Japan have a pretty good treaty, though. And I'm not really even certain if Singapore has a treaty or not with the U.S. I can't remember. Okay, so I think that's it for the day. I'm going to kind of call it a day. There's a lot of different, I think, additional questions on here that I didn't get answered. If I didn't answer your question, I will try to put that into my responses with the PDF that's going to get sent out hopefully tomorrow. And like I said, my screen is right now showing, or my presentation is showing my contact information. Feel free to email me, give me a call. You can always go check out my YouTube page. I know my son is a really big fan of the Wolf Group YouTube page. He's a 4-year-old that loves to get on YouTube every now and then to see some of the videos for kids, and he always likes to have the Wolf Group page in the background sometimes to watch some of my videos, even though he has no clue what I'm talking about. But if you want to see other presentations that I've done or other videos that I've done, you can always go to that page and check those out. Appreciate everybody's time today. I hope you learned something about the exit tax. And we look forward to doing, I plan on doing, I've been wanting to do for a while now, a presentation on foreign pensions, because there's been some drastic updates that have come out on those. So trying to put something together on that after the extension filing deadline. But also, I want to try to put together a year-end planning presentation, as it is my guess that between whatever has been done over the calendar year, with all the new COVID laws or packages that have been passed, and what may be passed before the end of the calendar year, there may be some fantastic income tax and estate tax planning opportunities for individuals and estates before the end of the calendar year. And so I think a lot of folks, if I had to give you 2 cents of advice, it would be if you're going to do some planning, the last 2.5 months of the year is the best time to do it. And this may be one of the better years to do that planning in. So with that, I wish you all the best of luck. Stay safe, stay healthy, and we'll see you next time. Thank you.